for logging in. Before I turn you over to Jeff and Chris, here's a couple of housekeeping items. Everyone is on mute. If you'd like to ask a question during the webinar, type in your question in the box on the right. Jeff and Chris will answer the questions at the end. The webinar will be also posted on our website for viewing on Monday, so feel free to watch it again if you'd like, or forward it to other friends and family who may be interested. With that, I'll turn things over to Jeff and Chris.
Good afternoon, everybody. This is Jeff Helms. Appreciate you joining us for our quarterly drive-through review, where we take a look at what's going on in the past quarter or year to date, and kind of try to give folks a view forward. These drive-through reviews have been very, very successful. We get a lot of great feedback. We appreciate everyone taking the time out of their day to dial in for it. So as Chris reiterated, if there's ever a time you cannot make it, we will be posting them on the website the following business day, so they'll stay up there for posterity's sake for a while. And by all means, feel free to forward them to other folks if you'd like to. So with that, we'll get started. We'll talk a little bit today, kind of what our agenda will look like for the day. We'll do a mid-year recap, talk about what the year has looked like in the markets and the economy and why. We'll take a few minutes to look at kind of an outlook for the rest of the year, short-term, and then some long-term themes that we like and think people should remain focused on. And then, as usual, we'll end with a few thoughts on some planning tips. So with that, we'll get things started. In terms of mid-year vital signs, we've taken to calling this economy the plow horse economy, primarily because it seems to just slog along and trudge along. Since the recovery in early 2009, the economy certainly hasn't shot the lights out with respect to growth, nor has it even closely approached what is considered to be a reasonably healthy number of around 4%, GDP growth every year. The numbers are somewhere between 2 and 3%, which is growth, which we're happy about, but it's certainly not robust growth that you need to really show expansion in the economy. But the economy does continue to expand and grow. We had a bit of a contraction in the first quarter, where the revised numbers showed that the economy contracted by about 2.9% in the first quarter. You may recall when that original report came out that there was a lot of speculation that was due to an unusually harsh winter, and that the subsequent quarter's results, the second quarter, would bear that out. That has in fact been borne out, and the projections for Q2, while they're very preliminary, look like a return to a normal expansion of somewhere between 2 and 4%. So it does appear now that the economic contraction in the first quarter was largely due to adverse weather events on things like housing and hiring. And so, we expect the Q2 numbers to look a lot more healthy. And in fact, things are continuing to get better. So, this plow horse economy, we're going to be in it for a while. We don't see any signs of growth accelerating. Chris will touch a little bit on that when we get to talking about employment and productivity specifically, because there are some, potentially worrisome trends there. So, and in terms of talking about jobs, we'll touch on some of those themes now. Unemployment has dropped to 6.1%. When we started out this whole recovery back in 2009, unemployment stood at about 7.8%. So on a percentage basis, unemployment numbers look pretty good. As much as the Fed would like to take responsibility for those employment numbers, as we've talked about in past webinars, we think that the effects of the Fed's quantitative easing are marginal at best. And so, Chris, you want to?
Yeah, I think it's important for folks to realize, too, that there is always a degree of unemployment in an economy. And what that normal rate of unemployment is, at least in the eyes of our government and the Federal Reserve, is somewhere around 5.5%. So as Jeff mentioned, we coming out of the recession of 2008, we were at nearly 8% unemployment. Today we're at 6.1. The rate of bringing down unemployment has been increasing. So we're nearly to the point where, for all intents and purposes, the economy will be at what is considered to be full employment. So we're almost there. And when that occurs, it's at that point that we can begin to see some more changes coming out of the Federal Reserve. But jobs have been being added at a rate of about 280,000 jobs a month. During the recession, we have gained all of the jobs back in terms of total number of jobs. We have gained all of the jobs back that were lost during the recession. Now that doesn't mean that everyone that had a job then necessarily has a job today that had lost it, but it does mean that our economy has replaced the total number of jobs, and so we're back at a point where we see positive growth, net growth in terms of employment. As that continues to play itself out, it creates this virtuous cycle of, jobs beget spending. Spending is part of consumer confidence. Spending gets put into the economy. That creates more jobs, and we have this snowball effect, if you will.
Yeah. So as Chris said, people have to keep in mind that historically, if you look over the past 50 years, the average full employment rate, or I should say the unemployment rate at which, we're considered at full employment has been somewhere around 4.5%. Between 4.5% and 5% is considered by economists to be full employment. You're never at 0% unemployment, never have been. And so, there's some good news in that we've seen the labor market strengthen. As Chris said, we're at about 280,000 jobs a month. Last year, we were adding about 200,000 jobs a month at the same pace. So hiring has picked up, and if you saw our newsletter that went out a couple of days ago, you would note in there that the hiring has been fairly widespread in the economy, from manufacturing to government, local government hiring, and across the spectrum. So it hasn't been isolated to one particular area. And we find some of the news bites and stories that we see of a political nature on the nightly newscasts and stuff kind of interesting, that certain politicians would position themselves as champions of the downtrodden, and they seem to continue to parade out these stories of people who are suffering in the economy. And while we certainly don't doubt for a moment there are people who are still disadvantaged as a result of the recession or have had trouble finding gainful employment, for every one of those, there's two other people that have gone back to work. And so, we think that the employment picture today looks far more rosy than perhaps someone who might, let's just say, be up for re-election in November might be painting the picture. The troubling thing about all that, though, is that there's a very strong relationship between employment and productivity gains in the economy. And Chris, I don't know if you want to say a word or two about the relationship between those two and the fact that we're seeing them slow down. But
right. So when we look at what drives an economy, one of those factors is the rate of productivity of its workers. And normally, coming out of a recession, you'll see companies begin to put money to work in buying new tools for their workers. And as they do that, the workers become more productive. And as productivity increases, the economy increases. So, it's a good thing when businesses are equipping their employees to be more productive by either expanding the manufacturing plant or enabling them to do more with better tools. While we've seen unemployment numbers increase, we haven't necessarily seen the rate of productivity increase at a rate that we would have suspected. And so we may be entering into a phase in which, if low productivity gains will perhaps inhibit to some degree the rate of growth in the economy. So when we've been growing, albeit at a modest 2.5% rate coming out of the recession, which is in and of itself below average, that rate of growth may be decelerating going forward unless we begin to see improvements in the rate of productivity increasing. So these are things that we look at behind the scenes that help guide our thinking on what do we see on the horizon in terms of what the economy is likely to do. And one of those signs that we see right now that causes a little bit of not necessarily concern or worry, but it perks our antennas up to what potentially could lie ahead, is the fact that we're not getting the productivity gains that we typically get or historically get in a growing economy.
And the final comment I would make on the whole productivity gains is productivity is increasing, but what we're suggesting is we think all the low-hanging fruit is gone. Companies laid off a lot of people in 08 and 09 during the recession, and rather than hiring a whole bunch of people back, they retooled. They employed technology and made it easier for them to make more widgets with fewer people, and all that low-hanging fruit is gone now. So companies are going to have to continue to innovate to show productivity gains. So we'll move on to talk a little bit about inflation. Right now, inflation is running, on a monthly basis. You look at the reports, it's somewhere between 1.5% and 2% annually. For reasons that are still not clear to most of us, the CPI, the Consumer Price Index that the government used just to calculate inflation, does not include food or energy. So if you don't need food or you don't need energy, then inflation's running at about 1.5%. But if you add food and energy into that, we think it's the nominal rate's probably more along the historical lines of 3%, because of course the price of energy and the price of food continues to increase. There are some signs of inflation stirring a little bit. You may have noticed in the paper yesterday or on the news last night that at the latest Federal Reserve meeting, the Fed announced that by October they will cease their bond buying program that was designed to keep interest rates artificially low. We think when that happens, you're probably going to get a spike in inflation. You can't inflate your balance sheet like the Fed has over the last 3 or 4 years without inflation at some future point. So it's certainly coming. The question, of course, is when we're going to start to see signs of it. And the indications are it'll be sometime between now and mid-2015 when you might begin to see inflation ramp up a little bit.
Yeah, and to add to that, one of the main drivers of what causes inflation is wage growth. Now, coming out of the recession when we were at 7.8% unemployment, it was easy for companies not to raise wages a great deal. As that unemployment number has come down, more people have gone back to work, more jobs have been created. The supply of workers has begun to shrink, which is beginning to show signs of wage growth. And wage growth is a primary contributor, a major factor of what pushes inflation up, particularly on those items that aren't food or energy. It's the home building that's pushing rents up. It's pushing occupancy up. It's pushing the price of cars up because people can afford to buy them. So we see inflation closer in our view than we have in the past, rather than farther away at this point.
Okay, well, let's look at a couple of other vital signs here. Interest rates, we saw interest rates drift down over the second quarter a little bit, which helped bond prices. Everybody has been concerned about rising interest rate environments, which of course are bad for bond prices. And, again, this is a part of the conversation about the Fed cutting the spigot off, if you will, is, an attendant effect of that is a rise in interest rates. And the Fed has indicated that they plan to start raising rates next year. So at the latest Fed meeting, they said that they would anticipate beginning to bump rates up next year. It's interesting, though, that I think that the Fed's going to find themselves in a bit of a pickle because all these things we talked about before are all tied together. If your productivity gains slow down and your hiring slows down as a result of that, and the economy still grows but at a tepid rate, so if growth slacks off a little bit and corporate earnings soften up a little bit and we hit a soft patch, it's very, very difficult for the Fed to make a case for raising interest rates in that environment. Typically, you raise interest rates in an overheated economy or an overheated market as a way to kind of dampen that growth. So, we think that, interest rates as set by the Fed may actually remain lower through next year unless we see more rapid growth and an expansion in the economy.
Where we would see potential increases on interest rates are on those fixed income, those bonds that have longer maturities. The Federal Reserve controls the interest rate on T-bills and things that mature on a very, very short time period. The market controls the interest rate on longer-term investments. And it's those that we would suspect would probably move up first before the Federal Reserve. And the reason why that may happen is as the Federal Reserve stops purchasing mortgage-backed bonds or 10-year government bonds like they have been doing for so long, as that comes to a close later this year, that's a major buyer out of the marketplace. And as a result, the price of bonds, the interest rate on them is likely to increase. And that would be on things like intermediate-term bond funds. We could see the risk of those bonds being in jeopardy. So hence the reason why we don't own any of those, by the way.
Okay, so moving on to earnings. There are a lot of questions about where the market, the investment markets are as it relates to equities, stocks today, both domestically and internationally. Gee, the market's hitting all these record highs, and we haven't had a correction in a long time, and what's next, and all the typical conversation we get at this point in the business cycle. At the end of the day, what determines future stock prices, when you eliminate all this other noise, is earnings and the quality of those earnings. If companies are being more productive and being more efficient and innovating and finding ways to increase their profitability in any market cycle or market environment, the market as a whole is going to reward that type of behavior looking forward. So stock prices are largely a reflection not only of current valuations, but of expected future valuations of these companies. So earnings are about up somewhere between 5 and 9% year over year, and they're holding decently due to the productivity gains we've had over the past 2 or 3 years. Like we said earlier, though, we think the low-hanging fruit is gone. It's getting harder for companies like Apple to innovate and stay well ahead of their competitors. And, we think earnings will probably slow down. That the rate of earnings growth that we've seen in the past 2 or 3 years is just fundamentally unsustainable. Trees don't grow to the sky. You have to have some softness in that earning cycle and in order for it to firm back up. And so, we think that while companies are going to continue to show earnings gains, we think the percentage growth in those gains will be lower in the future than it has been in the past couple of years. And that has implications for the stock market, particularly for domestic stocks here. It doesn't necessarily mean that we're in for a huge correction. What it might mean is that we're in for a regular kind of a moderate correction, or we might be in the sideways market, in a trading range, as they call it, trade bound, where we don't see much gain or loss in the market for a period of time. So any or all of those scenarios are certainly possible as it relates to domestic stocks going forward. But again, we've always said this, if you really want to know what direction the stock market is going to go in the future, the best divining rod you can have is earnings and looking at how earnings are doing. And we're just entering earnings seasons right now, so we'll begin to see a lot of earnings reports coming out. So as far as markets year to date, you've seen us use this chart before. We think it's a very, very effective way to explain your returns on your portfolios and to compare returns on your portfolios. Your returns are explained by what you own. And so I'm going to let Chris talk through this chart a little bit in terms of what areas of the market saw gains in the first half of the year, what markets were more flat, and what was down, and what it means to diversified portfolios.
Sure. So when we look at asset class returns, which this colorful chart outlines, this is helpful for us to realize that not every asset class behaves the same at the same time. So far this year, our leaders, the top asset classes has been real estate. Real estate was up, almost 17% or so this year. The U.S., the S&P 500, the largest 500 stocks in the U.S. is up a little over 7%. Commodities are up about 7% as well. You'll notice that commodities were one of the worst performing asset classes last year. So when we review what assets have done well against those that have done poorly, we can see that it's rather random in its nature. If you would have asked me at the end of last year what I had expected real estate assets to be the top performing group through mid-year, it wouldn't have been the one that I would have personally selected. So when we construct a portfolio, we have to remember that what we're doing is trying to achieve a return that meets your long-term goals without taking on too much risk. And the way that we do that is through diversification. This chart is diversification in action. It shows us the different asset classes and their returns and how they can fluctuate over time. You'll follow the line that's on here that zigs and zags through the center of the chart. What that represents is a blended portfolio of these different asset classes. Roughly a portfolio that consists of 70% equity, 30% fixed income. And the return year to date on that portfolio, that hypothetical portfolio, is a little over 5%, 5.3%. And that's commensurate with the returns that we're seeing on a moderate growth portfolio across our clients' returns. So what we're seeing here is that portfolios are giving us the returns that we would have expected from them, because what we're looking for is to achieve the returns provided by the market. And it's important to remember that we don't just own real estate, and we don't just own the S&P 500. We own all of these to some degree. So we need to set our expectations to have a smoother ride from left to right on this chart.
And so just a couple of other quick comments to reinforce a couple of things here. For those of you that are existing clients or just those who are listening in, we would always advocate that this chart proves everything about how unknowable the future is. Nobody knows what next year's winners and losers are going to be. It's impossible to predict it. So the logical conclusion is you need to own all of them. You need to own all of these boxes. And the amount that you own in each box is a function of your tolerance for risk, right? So the only way we can guarantee that you'll own next year's top performer is if you own all of these. And so you can see from year to year, it's been difficult to predict what the winners and what the losers will be. It just makes good common sense to allocate your assets across all these different categories. And so for those of you who are now receiving your second quarter performance reports from us, you're going to see results very, very similar to what we're showing in the highlighted area here. There's not going to be much difference. If you're a little less risk-oriented, your returns might be a little lower. If you have a more aggressive portfolio, your returns might be a little bit higher than that. But this is the best teaching tool that we could use to impart to people the importance of diversification and asset allocation in order to build a boring portfolio. Investing should be boring. It should be like watching paint dry. It shouldn't be exciting. And if you can trace that asset allocation line across the middle of the chart here, you can see that your returns tend to be right across the middle. The reason is because you own all the ones above it and you own all the ones below it. So if there are any questions about that, be happy to answer them. Just type a question in and we'll be happy to address it. So talking about what's been driving the markets, let's talk about that for a minute or two. There are a few elements that have continued to drive the markets. The S&P 500 in this country, the 500 largest stocks in this country, were up 32% last year. Year to date, they're up about 7%. Most people would have thought that the markets would have taken a breather by now, or that perhaps we would be, in a little pullback or a correction by now. But yet the market inexplicably seems to continue going up. What's driving that? Well, there are a number of factors. The first one is there's a little bit over $9 trillion, that's trillion with a T, in cash right now looking for a home. Everybody on the call today probably knows what cash pays today. Cash pays nothing today. The price you pay for protecting your principal is no return and a lack of purchasing power in the future. That cash is looking for a home. It's looking for somewhere to go. So every time we've seen a pullback in the stock markets, whether domestic or international stock market, when we've seen a pullback, that cash has stepped in to fill the void and gone to work. And that's what's kind of kept the market from experiencing kind of a traditional 10% correction during the year. The market on average has a 10% inter-year correction. We've not had one in 18 months. So, one of the reasons is that there's so much cash looking for a place to earn something that it pours in anytime we have a pullback. Another reason is a lack of volatility. People have gotten fairly complacent, which we like. It makes it easier to manage behavior when people are complacent. The markets have been fairly boring, which we like. Another is earnings. We already talked about that. Earnings tell the story. If companies are improving their productivity and earning more money and increasing their profits, that will be reflected in stock prices. And finally, the overall economic outlook is still good. While it's tepid, growth isn't where we'd like to see it be. We've kind of given you some reasons why that is, but the economic outlook is positive. It is not negative. So when you combine all of those things together, that is really the tail of the tape in terms of defining why we find ourselves with an equity market that's up, somewhere between 5 and 7% year to date after such a huge year last year. Again, we're overdue for a correction. Corrections are temporary, always have been, 100% of the time. And we would remind listeners that 100% of the time that the market has gone down, it has gone back to new highs afterward. 100% of the time, not 50% of the time, 100%. So what are the risks we see facing us right now in the short term, kind of cyclical or, based on the general short-term 4-year, 5-year business cycle? What are the short-term risks that we see in front of us, Chris?
Yeah, and we've already touched on each one of these. The first is earnings weakness. Jeff had alluded to the fact that when earnings begin to slow down, we've been on this rate in which earnings year over year for the 500 largest U.S. companies have been increasing each year more than they were last year. When that begins to diminish, we're likely to see a breather in the market. Again, the market is forward-looking, and if earnings appear to be declining in the future or not growing at the same rate, then that is cause for the markets to pause, evaluate the situation, and then move from there. The second risk is the wage growth, the employment. Again, we have seen some wage growth. I believe we're up 4% year over year in terms of wage growth. which is a positive factor, but it's not moving at a very fast clip when we compare it to other recoveries in history. So continuing to have modest, slow wage growth, while that can help businesses remain profitable and maintain their profitability, it does lend itself to consumers' inability to support themselves and maintain their standard of living. Productivity gains, again, we're not seeing the productivity growth that we would anticipate in a recovery at this stage. And so we're keeping a keen eye on that metric, because without productivity gains accelerating from this point where they're at today, we would expect the rate of economic growth to slow from where it's at today. What does that mean? If we're growing the economy at 2.5% year over year without productivity gains, we would expect that rate of growth to diminish somewhere between 1 and 1.5%. So if we thought that the rate of growth today was slow, that is something that we would definitely feel in our communities. Interest rate increases, again, this is something that we've been waiting to occur. It occurred a little bit a year or so ago, but with the continued purchases of bonds by the Federal Reserve, that stemmed the rate of interest rate increases and really surprised, I think, all of us in the markets. While we've been waiting for interest rates to increase, they just haven't. And so the comments Jeff made earlier related to the likelihood of the Federal Reserve raising interest rates or what the markets will do on long-term interest rates, we would expect that to have some influence here sooner rather than later. And in fact, we are of the opinion that we would have thought it would have happened by now. If interest rates go up, the value of fixed income investments go down. If you own those fixed income investments and they go down in value, that's going to be a headwind to positive returns in your portfolio. Now, we take pains not to have that risk in the portfolio. There are ways to mitigate it, but it is something to be aware of.
Well, and the whole point of the color chart that we showed a couple of minutes ago is by spreading your assets across all of these different classes, you've taken the guesswork out of it. The point of these webinars and sharing this outlook is not to suggest that we need to, quote unquote, do something, because these are all just observations on possible outcomes. The way to take the guesswork out of it is to have a properly allocated portfolio that's an all-weather portfolio that's set up to weather all kinds of opportunities and challenges. These risks that we're talking about here are very short-term or cyclical risks, but there's some long-term, more secular opportunities that we like, and we want to touch on these very briefly. We have about 10 minutes to go here, and I think these are the things that we want to keep people focused on. Most people build their portfolios to serve their needs over a 20 or 30-year period, particularly in retirement. That does not lend itself to trying to make short-term guesses or read the tea leaves. You need to build a long-term strategic approach, and people need to have an investment philosophy, not a market outlook. Having said that, let's talk about where we see the long-term opportunities for the economy and the market. There's really three themes that we like for the long run. What we call the manufacturing reboot in this country, the energy renaissance, and the technology revolution. We're going to touch briefly on each one of these with some what we think are fairly compelling long-term implications for the U.S. economy in general, but the global economy as well. When we talk about the manufacturing reboot, there are several reasons we're seeing what's called reshoring continue. Reshoring means companies that are based in the U.S. that move jobs offshore and are now moving those jobs back to the U.S. In the S&P 500, this is an important kind of factoid. In the S&P 500, since 2010, 150 of the largest 500 companies in this country have moved jobs back to the United States from overseas. That is a huge number, and it's a lot of jobs across a lot of different manufacturing disciplines. So why is that happening? There are a couple of reasons. The climate's right for it. American labor productivity has increased. We've been talking about that. People are doing more with less. International transportation costs a lot of money. Shorter supply chains cost less. Wages in China and surrounding countries are starting to go up, along with all the political unrest that you have in East Asia and that kind of thing, that you don't have here. So a shorter supply chain can save a company a lot of money, give it better control over production, and if we're more productive here, it's going to ultimately save money. I put in here, in deference to the World Cup, a score of China 10, US 1. That may sound like China romped on us, just like Brazil got romped on a couple of days ago. But in fact, that's not a win. That's a huge loss. What do we mean by China 10, US 1? The United States manufacturing produces about $1.8 trillion a year of our gross domestic production in this company, or this country. About $1.8 trillion is what manufacturing contributes to the economy every year. China's is slightly higher than that number, but it takes 10 Chinese workers to do the work of one U.S. worker to produce that. So China produces about $1.9 trillion in manufacturing in a year. The U.S. does about 1.8, but we do it with one worker for every 10 they use. That is a huge disparity. In other words, American factories are producing more than ever with fewer workers. And unlike the low-end goods with thin profit margins that China produces, let them produce toys and shoes and T-shirts and consumer electronics. We'll do medical equipment and computer chips and military jets, oil and gas, highly specialized stuff. And we'll continue to dominate in that regard. Is China a bigger economy from a manufacturing perspective? Yeah, they manufacture more stuff than we do, but it's T-shirts and toys. R&D, research and development, is huge. If you look at how much money the United States pours into R&D versus other countries, you can see that our R&D spending is $456 billion this year. As a percentage of our GDP, it'll stay relatively steady this year. But in 2014, 10 countries will spend 80% of the total R&D spending in the world. And the U.S. is a large component of that. And China, it's estimated that China will pass us in R&D spending sometime in 2025, maybe. So we will continue to be outstripping and outspending other countries on research and development, which leads to more manufacturing, right, and better technology. That's the R&D is where it all happens at. In talking about the energy renaissance, we've talked about this theme before. We're going to talk about it again very briefly here because I think everybody is aware of it if you've turned the TV on in the last year or two, is the dramatic difference in energy production in this country and what it's doing for this economy and also what it's doing for us geopolitically. What you're looking at on your screen right now is a satellite map of the United States. Chris, you want to talk about it?
Yeah, what we see here is our country at night with all of the lights lit up in the different metropolitan areas throughout the country. So you can see down in the bottom right-hand corner that big circle right there in the bend. That's Jacksonville at night. And you can see the I-4 corridor. As we look through here, we can see all the major metropolitan areas, but there's one area that's lit up that has no metropolitan area to it, really. And it's the one right up there called the Balkan Formation. We can see the circle of lights there. That is our energy infrastructure at work. That is the oil wells producing energy for our national energy supplies. And there's so much of it going on that at night it looks like a Chicago in effect.
The light that you see in the Bakken Formation up there, there are no people there, or no people to speak of, other than the people that are going up there to work in North Dakota. What you're looking at is them flaring off natural gas at night from the wells. It's cheaper to burn it off than it is to store it. So those lights that look like a major metropolitan area, it's not a populated area. That's flaring oil wells where they're burning the natural gas off instead of storing it, because all the natural gas storage facilities in this country are at capacity. Natural gas is dirt cheap. It's cheaper to burn it. If you look in Texas, down below in Texas down there, you can see the Dallas-Fort Worth metropolitan area. Below it, you can also see another string of lights down there. That is the Eagle Ford Shale, which is another shale formation that is producing like the Bakken. There's another area that I would point out to you here that is not lit up in California. In northeastern California is the Monterey Shale. The Monterey Shale is estimated to be between 2 and 5 times the size of the Bakken Formation, and they've not drilled a single well there yet. Sooner or later they will. California is a little bit different than everywhere else. But this is part of this whole energy renaissance that we've got going on, and we will begin exporting natural gas from Louisiana in the next 6 to 8 months overseas. Natural gas here, where it might sell for $4 a million BTUs, sells for $10 a million BTUs in Japan, for instance, or in the UK, all of which are net importers of liquefied natural gas. If you look at this next chart, you can see our annual petroleum exports have doubled in 5 years, and we are now a net exporter of petroleum, not an importer. That is going to have very serious implications for our geopolitical standing in the Middle East. When we are no longer dependent on Middle Eastern countries to supply us with what we need as a natural resource here, it certainly changes the leverage that politicians have as it relates to geopolitical strife that goes on over there. And I believe you're seeing that in some of the political policy that's being implemented now. But anyway, we think that energy renaissance has got legs. It's in its infancy. It's in the early innings.
Yeah, and it's not just related to what you would typically think of as energy. There are other industries that are affected. The chart that Jeff has up on your screen right now reports the petroleum exports, but you could replace the title of that chart with railroad revenue from shipping the energy resources around the country. It looks almost identical to that trend. So when people ask, why did Warren Buffett buy Norfolk Southern? This is why, because their revenue has has tripled, basically.
Right, right. In terms of the third theme, the technology, we spend more in this country by a long shot as a percentage of the world's total spending on IT than entire regions like Western Europe. We blow Japan and China away in terms of our spending as a percentage of the world total. And you gotta understand that all of these trends are linked together. Technology and R&D and manufacturing are the reason that we have an energy renaissance. If technology and R&D spending had not been done to figure out ways to extract this oil from places we knew where the oil was but couldn't get to it, we wouldn't be having this energy renaissance we speak of. We'd still be highly dependent on foreign sources. So all of these themes are not interdependent. They are interdependent. They all work together. And we talk about IT development. Things like nanotechnology, 3D printing, defense technology, drones. Who's the largest manufacturer of drones in the world? It's the U.S. by far. massive market share in drone manufacturing, and will be well into the future. Defense technology is an important one. Right here in St. Augustine, we have a large Northrop Grumman facility where they produce the E-2 Hawkeye, which is a surveillance plane. In a tour I took of the Grumman facility, it was very interesting to see that they build two versions of the E-2 Hawkeye. They build one version which they sell to other countries, allies, if you will, of the United States. The version they build for our own military has the most advanced technology in it, which they only provide to the U.S. So two very different planes with very different technology capabilities. One of them many, many years ahead of the other one in terms of the technology that it provides. So, there's an example, I think, of U.S. dominance in terms of their technology infrastructure as it relates to, the military. But we see that across non-military areas, too. As I said, 3D printing continues to revolutionize. They're printing medical parts out now. I mean, they're printing pizzas, for Pete's sake, that can be stored and manufactured for nickels in countries where poverty is rampant. You'll see some of this, these stories coming out over the coming year or so. But these new technologies are really going to revolutionize things, and all that's going to translate to a more prosperous economy. So with that, we'll start to wrap up. I'll let Chris talk for a couple of minutes about a few planning thoughts he has that can help you think about your portfolio and your planning in this market environment.
Yeah, and so in looking at where we're at mid-year with the performance of portfolios over the last 18 months, I thought it would be important to take a few minutes and put in context what we've seen and how that relates to long-term, and hopefully keep people focused on what's important. Over the last 18 months, as markets have moved higher, many investors are beginning to become overconfident in the stock market. So while Jeff and I go through and we list, our observations, we see investors in the marketplace coming into the marketplace looking to put money to work when they weren't here before. And so we think that investors are becoming somewhat overconfident in the returns that they're getting, and that's not hard to do when we've had no real volatility in the markets, and the economy is showing strong signs of optimism. So what we have to remember, and Jeff alluded to this, is it's not unusual. In fact, it's typical for stock markets, to pull back at least 10% once a year. And we haven't had that in nearly 2 years. So, that's a bit, that is a bit of a concern. And so when we set expectations, from our perspective, we don't know when it's going to happen, but we know it will happen because it always has happened. So we have to keep in mind that the market is somewhat overextended in terms of no corrections having taken place in nearly 2 years. So
let me add one fact to that, and it may sound like a confusing or a fact counter to what Chris just said. There are a whole series of valuation ratios out there that are meant to provide people with some perspective on whether markets are overvalued or undervalued. Overvalued would be a bubble, okay? Undervalued would mean there's opportunities there. All of the metrics and ratios that we watch, which show a 25-year average history for the United States and other markets, would suggest that the domestic U.S. stock market today is fairly valued. It is not overvalued or undervalued. It's fairly valued, okay? Now, what does that mean? Well, it would mean that if and when a correction comes, if it's just a normal part of the business cycle, we would expect it to be a normal correction, okay? If the market was 30% overvalued and a correction came, we would expect that correction to be more severe. So the market is fairly valued right now. It's not overvalued or undervalued. And people need to understand, and we can't tell people this enough, that corrections in the normal part of the business cycle should not be viewed with fear or suspicion or bad behavior. They're a natural, normal part of the cycle. You cannot have advances without declines. The price you pay for advances is declines. And the thing to do in those declines is look for opportunities to put more money to work. Remember what I said earlier, 100% of the time the market has corrected. It has gone back up to new highs. 100% of the time, not 50.
Yeah. And so the point that I'm stressing here is that we just need to maintain as investors, we don't need to become overconfident and forget about these experiences. Now, when we construct a portfolio and we manage portfolios, we take into consideration the risks of volatility, of fluctuating and changes by incorporating strategies that behave different. This is that diversification in action. We're combining different asset classes. We're also combining different investment strategies to, in attempt, dampen that volatility when it does occur. Since we haven't had any volatility, those dampers, if you will, those shock absorbers, really have been sitting on the sidelines. So when people are looking at their portfolio and they're seeing that they're getting that 5.5% return, and they're comparing that to real estate at 7, 8, 9, 10%, and they're wondering why they're not getting that, it's because we have these shock absorbers in there. So we have to maintain our perspective on and realize that we own all of these things, not just one of them. Now, that's important because when we look at that diversified portfolio, the thing that we have to keep in mind is the return that we need to earn in order to achieve our personal goals. So I call that our personal return objective. And that's what we compare portfolio performance to, is the return that you need for your particular financial goals. We're not comparing the performance of our portfolios to the S&P 500. We're comparing it to the return you need in order to achieve your long-term financial goals. So we'd like to remind everyone as we enter this midpoint of the year that we don't want to become overconfident in what the markets have provided to us so far. Maintain perspective that we own a broadly diversified basket of investments. And when we're measuring performance, we need to measure that to something that's relevant. And what's relevant is our personal return objective, not the S&P 500 or perhaps our neighbors' returns.
Okay, thank you, Chris. With that, we're going to wrap it up. There are no questions that have been asked, so we obviously did a very good job, Chris, if no one asked questions. The next drive-through review will be scheduled for Wednesday, October 15th at 4 p.m. You'll all get notice of that via email 2 or 3 weeks in advance, so you can put it on your calendar, but you can go ahead and put it on there if you want to. A replay of today's review will be available at the website. We should have it up tomorrow or Monday at the latest. So for those of you who think this would be useful information for friends or family or other folks, you'll be able to send them to the website where they can watch the webinar within the next 24 to, say, 48 hours, Monday at the latest. So with that, we will sign off. Thank you. Please let us know, by contacting us directly if there's anything that we can do for you. And we'll look forward to talking to you again next quarter.